Welcome to i-TUTOR Economics NCERT series. We were studying Chapter 6 Banking, and yesterday we discussed about the Reserve Bank of India and industrial finance, and we also learned about institutions like IFCI and their role in supporting industries. Today we are going to continue from that topic and discuss another important financial institution, the Industrial Credit and Investment Corporation of India, or simply ICICI. Okay, ICICI. So, we saw that one of the significant features of ICICI's operations was its foreign currency lending. Nearly half of its disbursements were in foreign currencies. Now, why was this possible? It is because ICICI had the facility to raise funds in foreign currencies, mainly from the World Bank, which was its largest single source of funds. From 1973 onwards, ICICI didn't just depend on the World Bank. It even started raising loans from international capital markets. That means it was able to tap money from investors and institutions across the world. When we look at its domestic resources, the major portion of ICICI's rupee funds came from issuing debentures in the Indian capital market. Apart from that, it also borrowed from the Industrial Development Bank of India, that is IDBI, and the Government of India. Now, if we see who benefited from ICICI's assistance, it mainly supported the private sector industries. That means ICICI played a key role in strengthening India's industrial base, especially among private companies. Now, let's move on to our next important institution, IDBI, or Industrial Development Bank of India. So, the IDBI was established with a very special purpose. What was that purpose? To act as an apex institution. Now, what does apex institution mean? It means that IDBI was created to guide, coordinate, and supervise the activities of other financial institutions, including banks. Initially, the IDBI was actually a subsidiary of the Reserve Bank of India, that is RBI, that continued until February 15, 1976. But from February 16, 1976 onwards, it was delinked from the RBI and made an autonomous corporation, which means it became fully owned by the Government of India and started functioning independently. Now, let's talk about its functions. The functions of IDBI are grouped into two main categories. What are they? Assistance to other financial institutions and direct assistance to industrial concerns. So, under the first function, IDBI provides refinance facilities. That means if institutions like the IFC, state financial corporations, that is SFCs, scheduled banks, or even state cooperatives, banks give term loans to industries, and the IDBI help them by refinancing, basically giving them back the money so they can lend more. Now, there is also a special feature of IDBI, something called the Development Assistance Fund. So this fund is very important because it helps industries that require heavy investment but have a low expected return. In simple words, these are projects that may not look profitable in the short run but are very important for national development. So, through this fund, IDBI ensured that such industries also got financial support. Finally, before 1982, IDBI also handled export financing. But later, when the Exim Bank, that is Export-Import Bank of India, was set up in March 1982, that responsibility was transferred to this Exim Bank. What is the full form of Exim Bank? Export-Import Bank of India, and it was established in 1982. Okay. Now, let's move on to the next part of our discussion, state level institutions. So far, we have discussed the all India level institutions like IFCI, ICICI and IDBI. Okay, now let's see how financial support is provided at the state level. That's where state financial corporations comes in. The state financial corporations or SFCs were established under the State Financial Corporation Act 1951. This act was passed by the Government of India to promote small and medium scale industries in different states. So, what exactly do SFCs do? Their main objective is to help in the development of small and medium industrial units within their respective states. In some cases, if required, they can even extend their financial help to neighboring states. Now, how do they help industries? They provide loans and underwriting assistance to industrial units, but only to those whose paid up capital and reserves do not exceed rupees 1 crore. Also, there is a limit to how much they can lend. The maximum loan amount that an SFC can sanction to an industrial concern is rupees 60 lakh. Now, where do SFCs get their funds from? They don't have unlimited money on their own, right? So, they depend on IDBI for refinance. That means IDBI helps them by reimbursing or refinancing the loans they give to industries. Apart from that, SFCs can also raise money by making temporary borrowings from RBI, then taking loans from IDBI, and by issuing and selling bonds in the market. So in simple terms, we can say that SFCs act as a bridge between IDBI and small industries at the state level. They make sure that industries that cannot directly approach large national level institutions still get access to funds for growth. Okay. Now let's move on to the next important state level institution, the State Industrial Development Corporation, commonly known as SIDCOs. Okay. We just learned about the financial corporation, state financial corporation, SFCs, right? They mainly focus on providing financial assistance to small and medium industries. But SIDCOs go a step further. They not only finance industries but also actively promote industrial growth in their states. So, what are SIDCOs? They are set up by the state government and are wholly owned by them. They are set up by the state government and are wholly owned by them. This means the entire ownership and control of SIDCOs lie with the respective state governments. Now, unlike SFCs, SIDCOs are not just financing agencies. They play a broader developmental role. That is, their main aim is to accelerate industrialization within the state. So, what are the functions of SIDCOs? Let's look at it one by one. So, first function is financial assistance. SIDCOs provide loans, give guarantees, and even underwrite or directly subscribe to the shares and debentures of industrial concerns. So, they help industries raise funds in multiple ways, not just by giving loans. Okay. Then, promotional activities is also a function of SIDCOs. This is one of their key strengths. They conduct techno-economic surveys, identify potential projects, prepare feasible studies, and even train entrepreneurs. So, they don't just give money, they help new entrepreneurs find ideas, assess viability, and build skills to run successful industries. Okay. Then, they conduct joint sector projects. SIDCOs also promote joint sector projects. Here is how the ownership pattern usually works. SIDCOs takes 26% of the equity. The private co-promoters contribute 25% and the remaining 49% is offered to the investing public. So this model combines public and private efforts for industrial growth. Okay. Then they provide infrastructure facilities or infrastructure development. SIDCOs also develop industrial areas by providing all the necessary infrastructure like roads, power, water supply, and communication facilities. They help create new growth centers where industries can easily start and operate. Then what is the next function? Administration of state schemes. That means they also handle various state government incentive schemes such as subsidies, tax concessions or grants to attract industries to the state. And the final function is it is a source of fund. And the sixth function is that it is a source of fund. Where do SIDCOs get their money from? They receive refinance facilities from the IDBI and also raise funds by issuing bonds and accepting deposits. In short, we can say that SIDCOs are the industrial builders of the state. They don't just lend money but actively create, promote and support industries at every stage. So, hope you understand about SIDCOs. What is the full form of SIDCO? Yes, what is the full form of SIDCO? State Industrial Development Corporation. Okay. Now, let's begin a very important topic, that is monetary policy. Before we go deep into the types and instruments, let's first understand what monetary policy actually means and why it is important. So, when we say monetary policy, it simply refers to the policy made by the central bank. In India's case, the Reserve Bank of India or RBI, to control and manage the supply of money and the rate of interest in the economy. So it is basically a macroeconomic tool used to influence the overall demand in the economy. Okay. That's why it is called demand side economic policy. The main idea is simple. By controlling the availability of money and the cost of borrowing, that is interest rate, the central bank tries to achieve key economic objectives such as controlling inflation, promoting growth, then ensuring price stability, maintaining adequate liquidity in the system and so on. Now let's look at a bit of background. Monetary policy became very significant after World War II. This was largely due to the contribution of Milton Friedman, a famous economist known for his monetary theory. And Friedman argued that money supply plays a crucial role in determining the overall level of economic activity. He strongly believed that the government should carefully regulate the growth of money supply to maintain economic stability. He even went to the extent of saying that Great Depression of 1930s, Great Depression of 1930s in US was actually caused by the wrong monetary policy of the Federal Reserve. He explained this in his famous book, A Monetary History of the United States 1867 to 1960. For his contribution, he was awarded the Nobel Prize in 1976. So in simple terms, monetary policy is the policy of central bank, and it is a central bank strategy to control money and interest to keep the economy stable and growing. Alright, let's continue from where we left off. Now that we know what monetary policy means, now we are going to understand the two broad type of monetary policy, that is expansionary monetary policy and contractionary monetary policy. It is very important for UPSC examination. So let's look at it one by one. What is called expansionary monetary policy? It is also called cheap money policy. So imagine the economy is going through a slowdown. People are not spending much, industries are not investing, and unemployment is rising. In such situation, the central bank or RBI tries to push life into the economy by making money easier and cheaper to borrow. And this is what we call an expansionary policy, or more simply a cheap money policy. How does the RBI do this? It uses its tools like reducing repo rate so that banks can borrow from RBI at cheaper rates, then lowering cash reserve ratio or CRR, so banks can lend more, and buying government securities from the market, which increases the money supply. And all these measures put more money into circulation and make loans cheaper. And the main purpose is to stimulate economic activity. When loans become cheaper, what happens? Yes, businesses are encouraged to borrow and expand. Consumers are motivated to spend more, and overall aggregate demand, that is total demand in the economy, rises. And as a result, production increases, employment improves, and the GDP grows. For example, during the COVID-19 pandemic, RBI follows an expansionary approach. Why? Because it reduced repo rates and injected liquidity to help businesses recover. That is about expansionary monetary policy or cheap money policy. Now we are going to know about contractionary monetary policy, or it is also called dear money policy. Now imagine the economy is overheating. There is too much money in circulation, prices are rising fast, and inflation is getting out of control. In such a situation, the RBI needs to step in to cool down the economy. So instead of pumping money into the system like an expansionary policy, the RBI does the reverse. It tries to pull money out of circulation. How does it do that? Yes, the RBI can increase the repo rate and it makes borrowing costlier for banks. Then it raises the CRR or cash reserve ratio. So banks have to keep more money with the RBI, leaving less for lending. Then sell government securities. This absorbs money from the market, and as a result, credit becomes costly and people and businesses borrow less. And the main goal of contractionary monetary policy is to control inflation and stabilize prices. When money becomes expensive, consumers cut down on spending, businesses delay expansion plans, and the overall demand in the economy decreases. This helps in bringing down inflation, though it may also slow down growth temporarily. So the two phases of monetary policy. Let's quickly revise the difference between two. So during inflation, what happens? During recession, what happens? Okay. During inflation, borrowing is easy, consumers buy more, businesses expand, more people are employed, people spend more, and in that situation we use a cheap money policy. And during recession, that is when borrowing is difficult, consumers buy less, business postponed expansion, unemployment increases, production is reduced, and in that place we used dear money policy. Okay. So what is monetary policy trying to do? In simple terms, the monetary policy helps to keep our economy balanced, not causing inflation and not causing recession. Now, depending on whether a country is developed or developing, the focus of the policy changes a bit. In developed countries, the goal is mainly stabilization, that is maintaining steady growth and controlling inflation. In developing countries like India, the monetary policy must be dynamic. That means it helps in economic growth, employment generation and development along with the stability. Now, let's look at each objective one by one. Okay. So first one, neutrality of money, then stability of exchange rates, price stability, full employment, economic growth, equilibrium in the BOP. Okay, now let's look at it one by one. Neutrality of money. Economists like Wicksteed, Hayek and Robert Stent supported the idea of neutral money. So what does this mean? Neutrality of money means money should not influence the real economic activities like production or employment. In other words, money should act only as a medium of exchange, not as a factor that creates booms or depression in the economy. Neutralists believe that changes in money supply often lead to economic instability. For example, inflation or deflation. So this said, the central bank should aim to keep money neutral, that is neither too much nor too little. It allows the economy to function naturally. Okay. Now, second one, exchange rate stability. Now the next objective is exchange rate stability. This was especially important under the old gold standard system. Under this system, countries followed a simple rule: expand currency and credit when gold is coming in, contract them when gold is going out. This means if a country had more gold flowing in, it could expand its money supply. But if gold was flowing out, it had to reduce it. By doing this, countries automatically corrected their balance of payment, that is record of transactions with other countries. And stable exchange rates are important. Why stable exchange rates are important? It's important because when exchange rates fluctuate too much, it can lead to instability in trade. Then loss of investor confidence and imbalance in payment. So stability helps maintain smooth international economic relations. Okay. Then next one, price stability. Next we have price stability, which is one of the most important goals of monetary system. Economists like Castle and Keynes, they strongly supported this idea. Price stability means keeping prices steady, not allowing them to rise too fast like inflation or fall too much like deflation. When prices are stable, people have confidence in the economy, businesses can plan better, and income and wealth are distributed more equitably. But remember, price stability doesn't mean prices should never change. A mild increase in prices, that is a little inflation, actually encourages production and economic growth. Okay, so it's about avoiding extremes, not freezing prices completely. Next one, full employment. Finally, full employment became a major objective after the Great Depression of 1930s. During that time, millions lost their jobs, unemployment was high, and economies suffered badly. Then came John Maynard Keynes, or J.M. Keynes, who in the famous book The General Theory of Employment, Interest and Money in 1936 explained that the government and central bank should actively use monetary policy to create employment. So full employment means everyone who is willing and able to work at the current wage rate can find a job. When there is full employment, what happens? People earn income, demand for goods and service increases, businesses grow, and the economy becomes strong and stable. That's why this became a central goal of modern monetary policy. Okay. Then economic growth. So what do we mean by economic growth? Economic growth simply means that the real per capita income of a country, that is the income of each person adjusted for inflation, increases continuously over a long period of time. Okay, what is economic growth? It means the real per capita income of a country increases continuously over a long period of time. In simpler words, it means the country is producing more goods and services, and people's living standards are improving over time. Now, how does monetary policy help in achieving this? Yes, the central bank, through its monetary policy, tries to maintain a proper balance between the total demand for money and the country's capacity to produce goods and services. If there is too much money in circulation, demand rises too high, and this can cause inflation. If there is too little money, demand falls, and it leads to recession or slow growth. So to maintain steady and sustainable growth, the central bank uses a flexible monetary policy. That means it adjusts interest rates, credit supply, and money flow depending on the needs of economy. For example, if growth is slowing down, the RBI may lower interest rate to encourage borrowing and investment. And if the economy is overheating, what does it do? It may raise interest rate to control inflation. And the main goal is to create a favorable environment for savings, investment and production, so that the economy keeps growing smoothly without instability. Okay, then now equilibrium in the BOP. Now the last objective, that is equilibrium in balance of payment, often called BOP equilibrium. After World War II means 1939 to 1945, and after World War II, world trade started growing very rapidly. But the availability of international liquidity, that is global money available for trade and payment, didn't grow at the same pace. And this led to many countries, especially developing ones, facing deficits in the balance of payment. Now what happens when a country has a BOP deficit? It means the country is importing more than its export. Okay, the country is importing more than its export, and hence losing foreign exchange reserves. When this continues, the country's ability to buy goods from abroad or to invest in development gets affected. So to avoid this problem, the monetary authority like RBI tries to use its policy tools to bring balance in the inflow and outflow of foreign currencies. For example, it may tighten credit to reduce imports or encourage exports by making the domestic economy more competitive. So maintaining this equilibrium is important, because if the balance of payment remains stable, it helps the country achieve its other economic objectives like growth and price stability without disruption. So all 6 objectives, you have already learned about all 6 objectives. What are they? Neutrality of money, stability of exchange rate, price stability, full employment, economic growth, and equilibrium in the BOP. So together, these objectives help ensure that the economy grows steadily, prices remain stable, jobs are created, and the country stays financially healthy both domestically and internationally. Okay, now let's move on to our next topic, recent advancements in the banking sector. So in the last few decades, especially with the rise of technology, the banking industry has completely transformed. Earlier, banking meant visiting a branch, standing in long queues and doing everything manually. But today, most of our transactions can be done anytime, anywhere, just with a mobile phone or a laptop. And that brings us to our first and most important advancement, that is e-banking. So e-banking means electronic banking. What is called e-banking? E-banking or online banking is an electronic payment system that allows customers to perform various financial transactions through bank's website or mobile application. So instead of going to the bank physically, you can transfer money between accounts, pay your bill, check your account balance, apply for loans or debit or credit cards all digitally. And how it works? E-banking works through the core banking system, that is the central system that connects all branches and digital services of a bank. When you do a transaction online, it directly interacts with this core system and updates your balance in real time. So if you transfer ₹1,000 online, both your account and the receiver's account are updated instantly, no matter if you are in Delhi and they are in Kerala or in a reverse mode. Okay, so what are the types of e-banking services? Do you know? Yes, internet banking, then mobile banking, ATM services, debit and credit cards, electronic fund transfer systems like NEFT, RTGs and IMBs. Okay. Now there are also something new called virtual banks or direct banks. These are banks that exist only online. They have no physical branches. Because they don't have to maintain building, staffs or other branch expenses, they can offer lower fees and better interest rate than traditional banks. So some examples include some new age banks or digital only banks that operate entirely through apps. In short, we can say that e-banking has made banking faster, safer and more convenient. It is one of the biggest innovations that changed how we handle money in our daily life, from cash based to digital first. Okay, alright. Now that we have understood what e-banking is, let's look at two very important systems used for interbank fund transfer. That is, transferring money from one bank to another. These two systems are NEFT and RTGs. NEFT means National Electronic Fund Transfer and RTG, Real-Time Gross Settlement. So both these systems are maintained and regulated by the RBI. Okay, imagine you have an account in SBI and you want to spend money to your friend's account in HDFC Bank. Now, even though both are different banks, you can transfer money electronically using either NEFT or RTGs. Both help in safe, quick and paperless transfer of funds. NEFT means National Electronic Fund Transfer. Okay, let's start with NEFT. In NEFT, transactions don't happen instantly. Okay, they are processed in batches like a queue. One group of transactions is settled and then the next one begins. That's why we say NEFT is a batch system, not real time. It operates in half-hourly branches throughout the day. Currently, there are 23 settlement batches from 8 a.m. to 7 p.m. on all working days, including working Saturdays. Okay, so if you send money at 8:30 a.m., your transactions might be settled in 9 a.m. batch. That's why it can take a little time. So in short, NEFT is slow but steady, processed in batches, perfect for small or medium value transactions. Now what about RTGs? Real-time gross settlement. Okay, now let's talk about RTGs. This is for high value urgent transfers. Okay, in RTGs, transactions happen in real time, which means as soon as you send, the money is instantly credited to the receiver's account. There is no waiting for batch settlement. Real time means immediate processing, and gross settlement means transactions are settled individually, not in groups or batches. Minimum transfer limit for RTGs is ₹2 lakh. Okay, so it's used mostly for large value transactions. And timing, RTGs are available from 7 a.m. to 6 p.m. on weekdays and till 11:30 a.m. on Saturdays. In short, we can say that RTGs are fast and direct for big transaction and it happens instantly. Okay. So to sum it up, we can say that NEFT works like a train, collects passengers and leaves at fixed time. That means collect transaction and leaves at fixed time. RTGS works like a taxi that goes on directly and immediately to the destination. So both are safe, efficient and supervised by the RBI, ensuring smooth money transfers between banks. Okay. Now ATM, that is automated teller machine. Do you know about ATM? Yes, ATM is a self-service electronic machine that allows customers to do basic banking activities without visiting a bank counter. You can withdraw cash, check your account balance, transfer funds, change ATM pins, deposit cash in some ATMs and so on. So ATM is a computerized machine that enables customers to access their bank accounts for cash withdrawal and other services anytime. First ATM was introduced in London, okay, in 1967. That is Barclays Banks. In India, ATM came during the late 1980s. Later spread across the countries rapidly, and today ATMs are available even in rural and remote areas. And ATMs revolutionized banking by bringing 24/7 service to customers. And ATM have been improving continuously. ATMs have been improving continuously. The next big changes include innovations. What it mean benefit? Contactless ATM transaction. Okay, it is a very big innovation. Okay, then instead of inserting a card faster, we can use contactless ATM transaction. Then fingerprint, then CCTV, etc. used. Okay. So already happening, what is already happening? Biometric authentication is used in India. Qatar National Bank also uses advanced biorecognition ATMs. Then these advancements help stop ATM card cloning, pin theft, skimming attacks and so on. Okay. Now what about Paytm? Full form, Paytm Payment Banks. So let's start with a simple question. Have you ever used Paytm to send money, pay bills or recharge your phone? If yes, you have already used one of India's biggest digital payment platform, that is Paytm. In August 2015, Paytm got a license from the RBI, that is Reserve Bank of India, to start a payment bank. That means Paytm could now not only provide digital wallets but also act as a bank with some restrictions. The Paytm payment bank started functioning as a separate entity. Here is the share structure. Vijay Shekhar Sharma, he is the founder of Paytm. His share is 51%. Then 197 Communication, that is the parent company of Paytm, their share is 39%, and the subsidiary of 197 share together 10%. So what is payment bank? Okay, let's explain this in a simple way. A payments bank is like a mini bank. It can do many banking activities but cannot lend loans or issue credit cards. It can accept deposits up to 2 lakh per customer. Earlier it was 1 lakh. Okay. Then they can offer debit cards, enable online and mobile payments, transfer money via NEFT, RTGS, IMPs or UPI. And note that it cannot give loans or issue credit card. Think of it as a bank for small transactions. Perfect for people who need digital payments and savings and not loans. Okay. I will tell you an example. Imagine Raju, a fruit seller. He doesn't need a loan but wants to accept digital payment from customers. So with Paytm payment banks, Raju can easily open a zero balance account, receive payments instantly and even earn some interest on his balance, all on his phone. Okay. So what are the significance of Paytm payment banks? Yes, it promotes digital India and financial inclusion. It helps bring unbanked and rural population into the formal banking system, encourages cashless transaction and also acts as a bridge between wallets and full-fledged banks. Okay. Now, let's understand the two very common terms that we all use almost every day, that is debit card and credit card. Let's start with a debit card. A debit card is directly linked to your bank account. Whenever you swipe or use this card for online payments, the money is immediately deducted from your account. For example, if you have 5,000 in your account and you buy something worth rupees 2,000 using your debit card, your remaining balance will instantly becomes 3,000. So basically, you are spending your own money. Now coming to credit card. A credit card allows you to borrow money from the bank to make purchases. Okay. you can then repay that amount later, usually by the end of the billing cycle, around 30 to 45 days. For example, if you buy something worth 2000 using a credit card, your bank pays the money on your behalf. Later, you will repay the bank the same amount, sometimes with interest if delayed. So in simple terms, we can say that in using debit card, you can spend your own money, and credit card spend bank's money and pay it later. So also remember, debit card helps you control your spending since you can spend only what you have. Credit cards help in building credit history, but if not used carefully, they can lead to debt and high interest. Okay. Now, what is NPA or non-performing assets? Okay, I'll tell you. Suppose when a borrower fails to repay the loan amount or the interest for 90 days or more, that loan is classified as non-performing assets. In simple words, it means the bank has given money to someone, but that person or company is not paying back it on time. Why is it problem? Why is it a problem? Banks earn money mainly through interest on the loans they give. So if many people stop repaying, the banks stop earning, and this becomes a huge loss. And what is the current situation? Right now, the total amount of NPAs in India is estimated to be around 10 lakh crores, which is a massive figure. Because of these losses, banks don't have enough capital to lend more money to others. So what happens next? The government of India steps in to help banks by giving them money. This process is called capital infusion. So this process is called capital infusion. Capital infusion. Okay, but here is the issue. The government doesn't have free money. It uses taxpayers' money, which means common people's money, to rescue these banks. So ultimately, when banks fail to recover loans, it affects every citizen indirectly. For example, till now, the government has already injected more than 2.2 lakh crores to support banks. During 2018-19 alone, around rupees 86,000 crores were given to recapitalize the banking system. Okay, so in short, borrowers not repaying, NPAs increase. When NPAs increase, banks lose income, and when banks lose income, government uses taxpayers' money to save banks, and the result is that common people are affected. Okay. Alright, let's now move on to another important reform in the banking sector, that is merging of banks, particularly with the SBI. Okay, before 2017, the State Bank Group consisted of SBI and its associate banks, and these associate banks worked under SBI but had separate identities: the State Bank of Trivandrum, State Bank of Mysore, and so on. However, in 2017, the Union Cabinet took a major decision to merge all the remaining 5 associate banks of SBI along with the Bharatiya Mahila Bank. Mahila Bank into the State Bank of India. This measure officially came into effect on April 1st, 2017. The banks that were merged were State Bank of Bikaner and Jaipur, State Bank of Hyderabad, State Bank of Mysore, State Bank of Patiala, State Bank of Travancore, and Bharatiya Mahila Bank. Earlier, State Bank of Indore and State Bank of Saurashtra had already been merged with SBI. Why was this merger done? This idea was to create one strong unified bank instead of many smaller ones under the same brand. This helps in reducing duplication of work, improving efficiency, strengthening the capital base, and better management and lending capacity. And after the merger, SBI became one of the top 50 banks in the world. Almost 37 crore customer base, around 24,000 branches, and around 6,000 ATMs across the country. Okay, in short, we can say that the merger was a historic move that made SBI a global giant, capable of competing internationally and saving customers more efficiently within India. Okay, now we are going to learn about money market and capital market. First, we can learn about money market. The money market deals with short-term funds. Always remember this thing. Money market always deals with short-term funds. That means money lent or borrowed for a period of less than 1 year. So it is a mechanism or system where people and institutions borrow and lend short-term money. And the main purpose is to meet short-term liquidity needs of individuals, firms, and governments. And the key players are commercial banks, then NBFCs, that is non-banking financial institutions, acceptance houses and so on. And the main instruments are treasury bill, commercial paper, certificate of deposits, call money, etc. For example, if a company needs money to pay salaries or bills for a few months until it receives its revenue, it borrows from the money market. That's it. Now, what about capital market? Capital market deals with the long-term funds. Always remember that it deals with long-term funds. That means money lent or borrowed for more than 1 year. It helps in raising capital for investment and development purposes. And the main purpose is to provide funds for long-term investment like building factories, infrastructure or expanding businesses. And the key players are investors, companies, government, financial institutions and so on. And we use instruments like shares, bonds, equities, mutual funds and etc. For example, if a company wants to build a new factory, it issues shares or bonds in the capital market to raise long-term funds. Okay. Now, do you know about demonetization? Demonetization means removing the legal status of a currency note, meaning that the note can no longer be used as money for transaction. So if the government declares that rupees 500 and rupees 1000 notes are no longer valid, that is demonetization. So what happened in India in 2016? On 8 November 2016, Prime Minister Narendra Modi made a surprise announcement. All rupees 500 and 1000 notes of Mahatma Gandhi series were banned overnight. And these all notes were to be deposited in banks or exchanged for new currency notes. Soon after, new rupees 500 and rupees 2000 notes were introduced. Interestingly, even though the government aimed to flush out black money, the Reserve Bank of India later reported that over 99% of all notes returned to banks, which showed how deeply cash was circulated in the economy. And what are the objectives of demonetization? Yes, removing black money from the country. How? Yes, to bring unaccounted or illegal money back into the formal banking system. It helps to bring back them. Then stopping corruption. That is, government believed that the corrupt officials and businessmen hoarded black money in cash. So banning those notes would destroy their value. Okay. Then curbing fake currency. Okay. Fake rupees 500 and fake rupees 1000 notes were reportedly being printed and circulated, especially across borders. So introducing new designs was expected to reduce counterfeiting. Then stopping terror funds. Many anti-national and terrorist groups were believed to be using fake currency for illegal activities. So demonetization aimed to cut off their financial supply. Okay, in short, we can say that demonetization was a bold step aimed at making India a cleaner, digital and transparent economy, but it also caused short-term pain for many sections of society. Okay. Now let's move to the summary part. As we have seen throughout our discussion, the financial sector is the backbone of a nation's economy. It plays a vital role in the development process by acting as a bridge between savers and borrowers, that is, transferring funds from those who save to those who need funds for investment. In simple words, financial institutions like banks, insurance companies and stock markets help move money from idle hands to active use, thereby promoting growth, employment and development. And over the years, India has undertaken major financial sector reforms to make the system more efficient and competitive. As a result, banks modernized their operations, adopted technology and improved performance standards to meet global challenges. However, by the 2010, a new challenge emerged, a sharp rise in non-performing assets. This means many borrowers fail to repay their loans on time, causing stress in the banking system. This issue reminded policymakers that while reforms improved efficiency, maintaining financial discipline and strong credit management remained equally important. In short, we can say that the financial sector has evolved remarkably, connecting savings to investment and driving economic growth. But managing rising NPAs has become one of the most pressing challenges in recent times. So that's all about this chapter. Hope you understand. Thanks for watching. For more related contents, do like, share and subscribe.